Hello, everyone. We're just going to let people flow in and then we'll get going. Hello, and welcome to Accounting for CEOs, a four-part series. I'm Julie Cranston, Director of the SBDC at UCI Beal Applied Innovation, and I'd like to thank you so much for joining us today. Today's webinar is brought to you by the SBDC at UCI Beal Applied Innovation in partnership with TGG Accounting. The SBDC is funded in part by the U.S. Small Business Administration and the state of California. The SBDC is here to help you start, grow, and succeed in your business by providing no-cost expert consulting and training such as this webinar. In addition to our regular consulting on business management and equity funding, we've also been helping our small business clients understand and apply for SBA loans like the Economic Injury Disaster Loan or EIDL program, and also the Paycheck Protection Program or PPP loan. We can also advise on how to administer these loans if you receive them, so make sure to reach out to us if you need assistance. We have a hotline set up and additional resources available. The hotline number is 1-800-616-7232. And if you're a tech or life science business, you can go straight to our intake form at sbdctech.org/contact. We also have a COVID-19 resource guide available at ociesmallbusiness.org, and we'll put all of this information in the chat feature. A little housekeeping before we begin. Everyone is muted during the webinar. Tomorrow, the recorded webinar and a PDF copy of the slides will be sent to all participants. There will be Q&A at the end of the presentation, but please feel free to ask questions during the webinar by clicking on the Q&A box at the bottom of your screen. We may not get to everyone's questions, but we will do our best. If we don't get to your questions, please email hkhaled@fullerton.edu, and we will attempt to answer them and get back to you. Joe will also provide his email at the end of the presentation. Our program today will be presented by Joe Johnston, Senior Accounting Manager at TGG Accounting, as well as the Director of Business Development for the LAOC region. During his time at TGG, Joe has supported businesses from the startup size through middle market growth and transaction. While industry agnostic, some of Joe's favorite clients have included medical technology and SaaS businesses. Joe has hosted dozens of technical and managerial accounting trainings for accountants and business owners alike to help them understand the power of operational finance. Joe received his MS in accounting from San Diego State University. Joe, thank you so much for being here again today. I will now turn the program over to you.
Thanks so much, Julie, and good, morning, now afternoon, everyone. Thank you so much for joining us. Quick shout out again to the SBDC for all the incredible work that you're doing. We're so happy to be partnered with you here. Now, gang, thank you so much for joining us for the second in our four-part series, Accounting for CEOs, with our emphasis today on the retail industry. I know that Julie already provided a background on myself, so I'll go ahead and skip that. But to give you an idea of the firm that I'm coming from, TGG Accounting, the short and sweet version is that TGG Accounting does not do any audits, any tax work. Everything that we do is outsourced financial and managerial accounting for small and middle market businesses that are looking to run their businesses by the numbers. So executives, managers, leaders in an organization, et cetera, that are trying to figure out how to make their businesses more effective and more profitable. This is what we work with our businesses to do. Some key takeaways today to know where we're headed. We're going to start out by taking a look at some of the characteristics of retail from an accounting perspective, and so that we can start to break apart pieces of the industry. We're going to move into something that we introduced in our last session, which is the TGG-Way basic business model for retail, and comparing that and utilizing that with the price-value matrix to figure out how you can benchmark your business against others in the industry and the retail space, and also where you're going to be aligning yourself in terms of being high value, high cost, and low value, low cost, and everywhere in between. We're then going to move on to talking about some best practices related to financial reporting and where we typically see issues with startups and even middle market businesses. And then finally, we're going to move on to a few KPIs and some CFO thoughts from our team that we think would be really helpful for you to keep in mind as we're moving forward with your business. Now with that, let's go ahead and kick this sucker off. When we're thinking about the retail environment, often in the accounting side, we try to start out by bringing things as simple as possible. Here are 3 key goals of the retail environment and how we're going to be doing them successfully. Let's not overcomplicate this. We need to buy something well. We need to sell it for more than it cost us to make a gross margin, and we need to do it quickly. If we do these things, we're 80% of the way there to our successful business. Machines don't need to be complicated to be right and to be successful, just like this little potato battery here. But let's take a closer look and break down some tangentially related retail businesses, right? Of course, here first we have our traditional and small privately owned retailers. These are going to be our grocery stores, our department stores, our apparel stores that are going to be selling off the cuff and working directly with suppliers and selling individual units to customers. Then, of course, we have our Costco's, our comparable businesses here that are in the big box size. These are bringing in huge volumes of individual products that may be direct to consumer, most likely direct to consumer, but selling them out in huge volumes. What's interesting about these, what we need to think about from an accounting standpoint, is that these are going to have similarities to the smaller retail business to consumer model, but they're going to be able to take care of, have some advantages and disadvantages related to those high volume of transactions. It's so to say that when you win big, and when you lose, you can lose big too. And of course, our tangentially related business, which we're seeing pop up at an incredible rate over the past 10 to 15 years, is the e-commerce related business. Now, I want to differentiate this here a little bit, that thought, from a SaaS model, where what we're really providing is a subscription-based service, software service. In an e-commerce model, we're still talking about, obviously Amazon is a huge mega giant at this point, but what they were previously when we're talking about, if you're selling sports nutrition through your website, if you're selling books, if we're selling apparel through your website, all of these are going to be in our e-commerce based model. And what really separates e-commerce from traditional retail on this side, on the accounting side, is our distribution model. So as we said, big box is still retail, but it's going to have some of those advantages and challenges similar to the wholesale model. And on the e-commerce side, we want to view that slightly differently because we're going to have that different distribution channel. You're not going to have storefronts. You're not going to have the same facilities. We're going to have fulfillment-based shipping and distribution instead of having over-the-counter sales and distribution. Now, when we're looking at the industry, if you're looking to start up your business, if we're interested in starting up a retail operation as soon as the climate looks a little better on the COVID side, what we need to understand is that approaching from an accounting side, there are pretty moderate to high startup costs. On the front end, all of our costs are going to be related to, if we're setting up a new location, we need to have tenant improvements that are going to convert maybe an existing shop to whatever our brand's going to be, even if that's a franchise grocery store, franchise retail. And of course, on the front end of financing, we're going to have to get inventory on the shelves. Financing on the front end is really on the front end of the retail business model. When we're not selling a service compared to a service-based business where we'd be paying out our payroll as we're providing a service to end customers, on a retail and an inventory-based model, we're going to have to get our inventory up front so that we have it on the shelves to sell. This can put quite a financial burden on the business, but as we're looking at a few of our KPIs and we're tracking our inventory and our payouts well, we can make some adjustments that'll help us manage cash flow. And of course, something that we can really do here is manage our logistics. An easy point on logistics is figuring out who our good supplier or suppliers are going to be. We need to find, one of the most important things that we can find are beneficial terms in terms of, when do we have to pay for our inventory if we're having it manufactured domestically or overseas? Do we need to pay for it in 30 days, 60 days, 90 days, 120 days? All these are going to make a huge difference, especially as we're comparing how fast we have to pay for that inventory that we're getting on the shelf and how fast we're actually able to turn it. In addition to this, we want to make sure that we're matching up the quality of goods that we're purchasing to the model that we're focusing on, right? If we're positioning ourselves as a cost leader for whatever our brand is, if that's sports apparel, if that's, fishing line, whatever that may be, we want to make sure that our costs are also appropriate with our supplier and that we're not overpaying or we're getting we're optimizing our quality to cost metrics here. In addition to this, on the logistics side, we need to make sure that we're maintaining strong inventory management. I will repeat this a few times during this webinar, but counting your inventory is one of the most important accounting processes that you can do in a retail and inventory-based business. Not counting your inventory is like not counting your cash in your bank account. It's money that we've already financed and that now we're gonna get ready to go sell. On this side, we also have to work with our marketing team, with our sales teams to figure out that we're bringing in the right goods. We have to be right on what people want to buy, or if we're not right, we need to monitor what isn't selling so that we can stop selling it. As we're getting into our KPIs, we're going to take a look at how we can monitor sell-through rates based on our different inventory product types and how important this could be. Because any space on your shelf that's taken up by inventory that's not turning means that we're taking it away from something that I could sell maybe in a day or two. And of course, we need to understand if we are in a grocery or a time-sensitive inventory deterioration market, such as a grocery store, that we're utilizing our inventory on a FIFO basis. That's first in, first out, and that we're pushing our inventory through appropriately. The last piece here, in terms of making sure that we're right on what people want, another factor we have to consider is demand generation. Have a formal marketing plan to understand what value you're providing to your customers, and whether that's low cost, low value, or high cost, high value, and figure out who are the appropriate people for that product and how you're going to be approaching them. Whether that's through having TV and radio commercial ads, or if that's going to be going through your local penny saver and online web marketing. Figure out what's successful in your industry and based on your positioning in that price value matrix. Now, and at the same time here, let's figure out what's appropriate based on our location. If you ever driven through the Central Valley, I can tell you one of the last stops on your way heading north, if you're headed to the San Francisco Bay, up the 5, is the Tejon Ranch outlets, where there's the last restaurants for food, for coffee, that you can feel really comfortable with. It starts to feel a little itchy when you're driving through the Central Valley for 300 miles and you see that one lone Wendy's out there. They'll still bring in a lot of traffic because they're out there on their own, but it's a different position in marketing, and understanding that can be extremely helpful. Next, let's take a look at retail through the eyes of this basic business model and this price value matrix, so we can figure out how we're going to benchmark our business. Now, if you didn't join us in our introduction session, the TGG-Way basic business model is something that we developed so that we could speak to different business owners and allow them to benchmark their business against others in the industry and understand where we really need to focus efforts, where we need to reduce costs and make an adjustment in our business. Now, the way that the basic business model works is extremely simple. Anyone could do this. You don't need to have a extreme financial background. So we can take out a pencil and we can write this down right now. With your basic business model, what you're going to do is take your business's income statement and start out with revenue. Write that in at 100%. All of these other items, as we're going along, are going to be writing in as a percentage of revenue. Revenue is what we're getting from our customers as we're making sales, of course, and your cost of goods sold are going to be what it costs you to actually produce your goods. In a retail environment, this is going to be our freight in, the purchase price of the goods, and if there is any assembly that's happening before we're able to sell, that piece as well. Our gross profit is how much we're making off of each of these individual sales before we get into all of the other expenses in our business. Now, this is extremely important as we're looking at removing our cost of goods sold from our SG&A. SG&A in this case being your selling, your general, and your administrative expenses. Your SG&A is everything that is not cost of goods sold and expenses. If it doesn't end up on a piece of inventory, it's probably going to be in your SG&A, right? All of our rents, our utilities, all of the salaries of our salespeople that are working on the floor. These are salespeople. These are still going to end up in our SG&A. And lastly, we're going to end up with our net operating income, which is the net of your gross profit and SG&A, to tell us what our take-home profitability is in the business. Once you have these figured out for your business, by just pulling out your income statement, start with 100% of revenue and move your percentages down, we can start to take a look at how our business compares to an ideal business. In this case, take a look at, if we figured out that, really we want to be targeting to have a 50% gross margin or gross profit, and we really found out that we were at 60%, that'll start to tell us why our net operating income is coming in at just at break even, or if it's even worse, we could be coming out at a loss lower than this. So it's a really simple way to compare your business. Now, we have to look at the basic business model in the context of the price-value matrix, which is going to separate your business from others out there. Now, the price-value matrix is your brand. It's you telling your customers and you living throughout the course of your business, how you're positioning yourself as either a high value, high price product or as a low value, low price product, right? So let's think about this here. If we're talking about the retail space, the most simple example I could think of here is Neiman Marcus. Neiman Marcus at the high value, high price side. I think I read their tagline, it's luxury from head to toe. When you're luxury from head to toe, you can make quite a good gross margin on selling your product, right? If we're Walmart, people go to Walmart because it's the low cost leader. We can sell a t-shirt for $3 because it only costs us $2 to make it. In this case, we're making quite a lower gross margin, but people are coming because it's convenient, it's easy for us. Now, these are two very extremes, and we're likely not going to be here. Where you're living is somewhere in this range. And we need to figure out where that branding is for yourself. You need to think about where you want to live for your business. So if we're thinking about, say, not Walmart, if we were thinking about Target, Target's may not be quite down on the spectrum where Walmart is. It's going to be slightly up. And if we're thinking about maybe a Banana Republic, something similar, that's going to be nearer to the higher end of the spectrum, but not anywhere near where Neiman Marcus is. If you are in a position where you're low value and low value and high price, no one's going to buy your product. And if we're high value, low price, we're not going to make any profitability. Anywhere in this range is where our business needs to exist to actually have profitability. Now, let's take a look at the basic business model actually in action for a retail-based business. In this case here, let's think about Neiman Marcus, and we can think about this conceptually that'll help us understand. So in this example, Neiman Marcus coming out as the luxury brand, they're going to be selling, quote unquote, higher quality products. For that same t-shirt, they might be able to sell it for $100 and it's only going to cost them $30 to make it. But so they're making a huge gross profit on every individual sale. But the problem is that they're going to make up all of that cost in their selling expenses. When they have to go out and they have to hire the models and have the nice furnishings with the chairs, and they're going to go around and give you cucumber water and have all the wonderful music playing in their storefront. They're going to make up all of those costs because they have to brand themselves that way to be high value. So they're still going to end up making that 10% net operating income at the end of the day. Walmart, on the other hand, and similar to the example that we mentioned, they might only be making 30% gross profit on their sale because they're the low cost leader. But at the same time, with low gross profit, they're still able to make up some ground because they don't have to market the same way, right? They don't have to market with the same level of strength that a Neiman Marcus does because they know that you're going there because it's convenient, because it's easy. But again, these are both of the extremes. What you need to think about for yourself is where your business lives in between these two models and live it all the way through, right? We can't pretend to be a low-cost leader when it comes to selling our product and then market ourselves and go through putting in fancy furnishings and things like that in our storefront, because then we're at the end of the day, we're going to have very low margins. In fact, we're going to come in at a loss, most likely. So figure out where you are in the basic business model, in the price value index, and live it all the way through. Now, in our last session, we talked through the 3 basic financial statements for any business: your income statement, balance sheet, and cash flow. In this session, we're going to be focusing really just on the retail section and talking about what are some unique characteristics that we can use to help our retail business in examining it in the financials. Something that I'd highly suggest, particularly when we're an inventory-based business, retail or manufacturing in this case, is building out what's called a contribution margin style income statement, which is going to separate what are our variable and our fixed costs. Now, for those of you that aren't coming from the accounting side, a variable cost in this case, the simplest way to think about it is that they really only occur when a sale occurs, right? So let's think about the purchase price of inventory. I know that every time I sell a piece of inventory, I'm getting the revenue, but it cost me one piece of inventory that I had to buy. Another variable cost here could be if you're in a retail environment, like let's say a Fry's Electronics, they're going to have sales commissions that are going to end up being variable. If we're offering discounts related to customer loyalty that they can only use when we're actually selling a product, these are going to end up being variable as well. On the fixed cost side, here we're going to be separating out things that occur whether or not we have a sale, right? So we're going to have rent, right? We may have our utilities if we're keeping the lights on all day, all the time. And we're going to have our non-commission based payroll. And in that note, when we're thinking about payroll, let's separate out in our minds if you have a salaried, say, manager versus hourly sales staff, sales staff. That's going to be more or less flexible based on what you're doing there. Here's an example of what a contribution margin income statement would look like. On your left side here is our traditional income statement. Using that same basic business model, we can see going through revenue, cost of goods sold to gross profit, SG&A, and NOI. On the right side, here's how we're breaking out our variable and our fixed cost components. Here in this case, we're going to be grouping together our variable COGS, right? All of our inventory purchases, plus our variable SG&A, so it's any of those sales commissions that we're having, and to get us down to a contribution margin. This is going to help us take a look at what our fixed cost coverage is. When we're talking about fixed cost coverage, let's imagine what life was like in, let's say, January and February, if we were operating our retail environment. As we're going through and we're selling our goods, right? We know that we're paying our rents, we're paying our utilities, we're paying our storefront staff. And of course, we have to pay for the inventory that we're purchasing. But if we're able to separate out our business in a contribution margin style income statement, come around to March, April, May, if our business isn't able to operate with the storefront, now what we're going to find out is we understand exactly what level of baseline costs we need to cover to make sure that our business has safety in terms of profitability. Even if we're going to convert to maybe a 50-50 e-commerce split, understanding what your fixed costs are can help us build in safety for a break-even point or for a margin of safety if we're expecting, questionable security in our retail environment in the future, right? We can find out how much cash, how much debt leverage we want to be able to have at least available to us to cover our fixed costs in the event of another catastrophe. Now, in another light here, if you are operating a retail environment where, let's say, you've taken on several franchise retail locations, one of the biggest benefits that I can relay to you is to ensure that you are accounting for these separately. Now, one of the most common accounting systems used for small business, even quite a few middle market businesses, is still QuickBooks and QuickBooks Online. An easy way that you can manage this without taking the extra cost of getting another QuickBooks subscription, getting another piece of the financials here, another software, is using what's called a class system in your accounting software. In QuickBooks Online, this is something that's quite simple, where every transaction we enter, we can assign it to a class that allow us to differentiate our locations or our business lines to make sure that we can see our financials separately. If we have separate locations, we'll want to be able to review performance on an individual basis to find out whether or not that franchise retail location is actually being successful for us, or if the rest of them are really carrying the team, and by how much and by what margin. So by using a class system or some other method here to separate our different locations, we can take a look at the financial performance separately and adjust for it separately before we see it consolidated. Now, before we move on from the income statement, I did want to run through something that we see quite commonly in the retail environment is having cost of goods sold and other expenses muddled a little bit. Now, this is still extremely important so that we can understand what our gross profit is, looking at all of our sales. In this case, cost of goods sold in a retail environment is actually quite simple. For the vast majority of businesses, it's really going to be our purchase price of inventory, as well as any freight in costs if we're paying those out to get our goods on the shelf. If we're in a position where maybe we're selling, say, furniture and we have to pay our salespeople or someone that's working in your back office to assemble furniture before it's available for sale, then we're going to have to add that for our cost of sales as well. Not cost of goods sold, one of the most common issues that we see is that having your storefront labor, all of your employees that are actually working in the departments, in your shoe department, out on your grocery floor store, if they're working for you, they're really salespeople, and we need to have that separated in our cost of goods sold. In addition to this, merchant processing, the cost of running credit cards, debit cards, warehousing inventory, rent and utilities are going to be separated here as well. Now, moving on to the next statement, our balance sheet. In the balance sheet in this case is really quite ordinary to those of a traditional business. We're still going to have our three major categories: assets, liabilities, and equity. It'll benefit us tremendously to have our current assets and our current liabilities separated for those long-term components. But one of the big differences here, of course, is making sure that we're recording inventory appropriately. Depending on the way that your inventory moves, we may want to take a look at creating sub-accounts to break out those different types of inventory. So if you're in an inventory environment where you're going to be assembling inventory, this is a great place to separate your inventory pre-assembly and then inventory available for sale so that we understand whether or not we need to actually apply labor to this beforehand. Another issue that we have here that comes up pretty often is if you're an apparel-based retail business, chances are you're having your inventory actually manufactured and created elsewhere in another country, and we're going to end up having to ship those to get domestically. Even if they are shipping from somewhere else in the United States, we're going to have inventory in transit. So what we need to take a look at is at our purchasing contracts to understand when do we take ownership and possession of our inventory. Because one of the metrics that we're going to be looking at here is we want to take a look at our sell-through rate, and we want to take a look at how many days it takes to sell inventory through. If we don't actually take possession of inventory and ownership of inventory until it arrives, but we're including several days, quite a few days when the inventory is still in transit, then we're really not going to be able to view this metric well, and it's going to impact us. We wanted to make sure that we can run our metrics well and keep track of where inventory is in these different locations. So it's not just accounting for the sake of accounting. Now, the two terms that you're really looking for on your contracts, on your purchase contracts, are going to be the shipping method and the ownership method. We may see these in these two terms, which are FOB destination and FOB shipping point. FOB means freight on board. And this is your two differences to say, do I take ownership when it arrives here at my location, or do I take ownership when it leaves the dock? This will allow us, again, to track our inventory on hand. And of course, on the tax planning side, we can use this method to see if we want to make a purchase right before the year end to maybe reduce our taxable income to pay out some cash and figure out what other methods we can use. This is what this looks like just in a quick illustration here, where in an FOB destination scenario, the seller, our supplier, is retaining ownership of the inventory until it arrives. And in an FOB shipping point method, as soon as the seller actually makes the sale, the inventory leaves the dock, it's in our possession. Now, team, let's take a look at some KPIs, some really exciting stuff that we can use when our financials are in good shape, when we have a good P&L, a good balance sheet, and we've gone through these exercises in the accounting, in getting our inventory in good shape. There's some great KPIs that we can use, some of them that are interrelated, that'll help us drive the business. So we're going to talk about quite a few here. If this looks like a daunting list, you don't need to write all these down this second. We're going to be going through each one of these over the next few tabs. Now, to start this off, I want to start off with two that, in my opinion, are some of the most important for our business. These two are critical to the success and life of our business. These are days to inventory turn and what's called our GM ROI, gross margin return on investment. Your days to inventory turn is still going back to one of those very first points that we made about making your business simple. How long does it take for us to sell our inventory? The formula for that is right here on the screen, but we're just taking a look at our cost of goods sold, the sales that are occurring, and our actual inventory held during the period times our number of days. What we want to be able to do when we're comparing our days to inventory turn is compare that to how fast we're paying our supplier, right? If we have 120-day terms in terms of our supplier, but we have to, but it takes us 90 days to actually sell our product. That means we have 30 days, hypothetically, of cash flow float where we've sold our goods without paying for them, and then we can pay for them out. Comparing these two to our days to inventory turn and sales helps us figure out what inventory we want to keep on the shelves. It helps us figure out what's turning, what's not, what's taking up useless space, and to figure out how we can manage our cash flow better. The next one here is taking a look at our gross margin return on investment. This is figuring out how much are we really making without looking at our facilities, our store cost expenses. How much are we really making on every single piece of inventory? If the more that we can break this down to inventory product types, the better off we're going to be for analysis standpoints. We want to understand if we're a department store, do we make more when we sell shoes or when we sell t-shirts, right? And making sure that we're stocking the right amount and variety of those, and we're making our storefront dedicated to that amount of space because of that. Now, taking this to getting a little dramatic here, with these two KPIs, here's how they're going to work generally. When our days to inventory is going up, our cash and our balance sheet safety is going down. Let's think about that, right? If we're paying out our supplier, but it takes us further to actually sell our product, this means that we're having a net outpouring of cash, right? Our safety in our business all lives on the balance sheet. Our cash runway, how long is our business going to be able to survive? Or is it going to be able to generate operating cash flows fast enough to support the balance sheet? So as your days to inventory sales are going up, our cash and our balance sheet safety are going down. The opposite is also true. The faster we can sell our goods, the more safety we're creating on our balance sheet. Now here on this side, taking a look at our gross margin ROI, as your gross margin ROI is going up and we're making more on a per inventory basis, on average and in our different inventory sectors, we have more cost coverage in our operating expenses and greater profitability for the business in the longer term. The opposite is also true, of course. Now, there's obviously a balance here. Selling your inventory tomorrow by making it free is not a good strategy. We have to keep prices and costs at a level that will allow us to maintain a gross profit margin that'll be successful, but also keep store traffic. Think of this in mind of your positioning in the price-value matrix and the basic business model, right? Are we going to be, how do we want to price ourselves to make sure we're still covering our costs and our gross margin, but still getting store traffic that's appropriate for the type of business and our positioning, right? And of course, one of the biggest issues we can run into here is making sure that we're right on what people want to buy. Because even if they come into the store and they buy nothing, that is a true issue. Now, We'll move into something a little bit abstract here. I know we have a lot of people coming in from from a SaaS-based background, from SBDC, so I thought you guys might appreciate this. A really common KPI when we're talking about a SaaS-based model is monthly recurring revenues. So if we have a subscription-based service, how many people are getting added to our subscription, and how many people are churning through it? How many customers are we losing on a regular basis? When you're in a retail environment, we're actually looking at something very similar here when we're talking about valuing it. Even if this is a franchise-based business, say we have one Sears department store, or we have, maybe that's not a perfect example at this time, but if we have a different type of department store that's in a franchise base, your your repurchase rate is going to be the equivalent here for these types of businesses. That's so to say that if we have 100 customers that visit us in the month of July, and 30 of them came back a second time, how many of them came back a third time and a fourth time? What's our consistency? Now, for quite a few businesses, they've developed interesting ways to track this. To some degree, if you're working with a merchant processor, you may be able to track this through credit cards and account information that you have that you do have the right to view, for those that you do have the right to view. But for larger businesses, what you may have seen, well, I'm sure all of us have seen really, are customer cards, rewards cards. Even if it's not a business-based credit card, like a Kohl's department store credit card, for example, it still may just be a customer card, such as a Vons card that isn't a credit card, but when you come in and you use it, you get the discounts for loyalty, but it also tracks what you're buying and how often you're coming in. Vons and Safeway are using this to figure out what their repurchase rates are for customers coming in. So this is really where 70 and 90% of the value of your business comes in whenever you're moving to sell, if that's on the horizon for you. It tells us about the success of our marketing and our sales, and of course about how our brand value is developing. Now, getting back to more of the financial side, something that we're going to want to track is, of course, our returns rate. We want to be able to understand what our return rates are for different types of products and compare that to our position in the industry. So for instance, in a grocery store environment, your return rate is going to be quite a bit lower because people would sooner throw out the food, unfortunately, or give it to the pet, if that's appropriate, than actually come back in and return it. But if you were to compare that to a Macy's or another retail department store, an apparel store, your return rates are going to be quite a bit higher. So understand your return rates, make sure that we're tracking this through in terms of the units and the dollars coming back, and compare that to what's tangent in your business, right? And this is also, of course, going to make a difference here of where you are on that price-value matrix. Higher the price, the value, the more likely someone's to return it if they don't like it. The lower the price and value, your Walmart, the less likely someone will come in to return it if they're not satisfied with the product. So track this to figure out how we compare with other businesses in our same, not just in the retail space, but really down something a bit more specific to your business particularly. Now, in a more traditional, more common analysis here, we have average basket and transaction size. This is here to tell us how much are people really buying when they're coming into our store. What's our average sales revenue per our number of transactions coming in? This is telling us about product placement, right? So to say, do we have the right things on the shelves? Not just one product's in the right place, but 4 or 5 products that are all leading right up to the cash register are in the right place. If we have multiple products that are of the same type, but they actually have different levels of value, right? Maybe we're selling pairs of shorts and we have a low cost, a mid-low cost, a mid-high cost, and a high cost. How are we positioning those to get those in front of customers to try to get them trending towards mid-high instead of mid-low? So looking at your average basket size is going to help us really figure out how our in-store marketing is working and what people are really coming in to buy. Think candy bars at the checkout aisle. What opportunities can we take advantage of? Next, particularly important, if you have inventory that's of a deteriorating value, anything that's food and beverage, grocery, that we're carrying, or whatever it may be for your industry that deteriorates in value over time or quickly, we want to take a look at our sell-through rate, which is calculated here on the screen. How much of our inventory are we able to sell through every month, and how quickly do we need to be able to replenish it? If it's possible, again, another great tool for valuing your different products. If we're in a grocery environment, we're constantly having to throw out the carrots, right, or whatever it may be. We want to be able to understand that that's the product that we can't sell through, and we either want to position ourselves differently in terms of marketing, or we want to make sure that we have the right products on the shelves that are really going to sell us through and get us the gross margin we need. Because if we have to throw out our inventory and we have spoilage, there's really no greater pain. Now, something a little abstract that I think is very, very interesting, and really any storefront related retail location should be considering, is have a conversation with a commercial real estate broker that you trust. Talk to 3 or 4 that work in your city, that work in your county, and start talking to them about, here's my business, here's my location, how are other comparable businesses doing on their sales per square foot? Because what we really want to go for here when we're taking a look at our facilities expense, our rents, we want to make sure that we have the right size space for the sales that we're doing. This will help you figure out this will help you renegotiate your leases if we're figuring out how much we're going to be paying out for these. This is going to help you figure out really what locations might be better than others, even before we open a retail operation. Or if you're interested in buying a franchise retail space, doing this evaluation beforehand, get all of your prospective purchased franchises financial statements to figure out their sales per square foot, speak to your commercial real estate broker to figure out what the appropriate sales per square foot are in those different locations to find out what's a good opportunity for you. Here are the goal in this case is really optimization. That's not to say that even if you have a product that flies off the shelf, if we have too small of a retail space, we may not be able to sell as much. So it's about optimization, not necessarily about one way or the other. Here are some pre-COVID examples. I doubt these are great today, but when you speak to your commercial real estate broker, get this information and make sure that it's region and location specific for the type of space you're looking for. Another very common one is taking a look at labor efficiency. This is something that we look at both on whether you're in the restaurant industry or if we're in a retail sales environment. Taking a look at our labor efficiency helps us figure out whether or not we're overstaffed at certain times of the day and understaffed in other parts of the day. We want to figure out what is optimizing us to make sure that by having the right amount of people in the door, having the right number of sales associates on the floor, we can help and provide the customer service that we want to provide to our customers so no one leaves. But then we're not overstaffing and we're just paying out all of these additional labor costs without really getting a benefit or not getting the most benefit. They say that a healthy amount of stress is a good thing. So we have to balance that with our employees as well. And again, one more time, taking a look at your storefront labor cost and sales can take it to another level, not just by looking at a single day and taking a look at, or different times of the week in storefront labor sales. Figure out how this works at different times of the day to make sure that we're staffing appropriately to cover positions. This is a extremely common metric that all of the large restaurants are using, grocery stores. If we're in a retail environment, even in the really large sizes, this is something that they're breaking down for them. So we should have access to this as well. And last but not least here, a very common issue that we need to take advantage of is figuring out what our shrinkage and our variance is on inventory counts. Not counting your inventory, again, is like not counting your cash. It's one of the biggest things that we're going to pay for in our business. For your business, it may well be the most expensive thing. But we want to track our inventory as we're doing counts, as we're doing these progressively, whether they're monthly, quarterly, weekly, to figure out how much is missing, lost, destroyed each count. and to figure out where that's coming from. It's a huge burden. It's going to go direct to our bottom line, of course. Now, team, I hope that you had some fun and were able to pull some great metrics out of here that you think are going to be useful for your business. We've tried to provide as many of the formulas as we can, so you can go back and refer to this later. But we've talked through a bit of the characteristics of the retail environment, of course, touched on our basic business model and price value matrix, and have gone through some of those best practices on your financial statements and keeping your financial statements in good shape to get you through. When our financial statements are in good shape, we can run good metrics on them, right? Garbage in, garbage out. Have to have good financials first, and then we can get all of this incredible data that's going to help us drive the business and help you run your business by the numbers. Team, just kind of a little marketing here where for our next few series, next Thursday, we're going to be talking about the manufacturing industry. And if you have friends that are working in the manufacturing or software industry, these are going to be each Thursday for the rest of the month. If you have any questions, of course, feel free to reach out to SBDC or reach out to us directly at TGG Accounting at info@tgg-accounting.com or through social media. We do offer TGG University courses to train more folks on accounting and accounting concepts. And with that, I'll stop chattering here for a minute and kind of open it up to any questions. If your first question is whether or not this is a bar, I promise this is a Zoom screen and it's a coffee house.
All right. Our first question is, what is SG&A again?
Sales, general, and administrative expenses. So if it doesn't end up on a product, if it's not part of the product that we're selling in a retail space, the most likelihood is that it is SG&A. So all of your selling expenses for the storefront folks that we have, your general expenses, if we have certain licenses, if we have fees, if we have to pay for whatever it might be in our store, furniture and fixtures are going to end up down there when they're not capitalized.
Sorry, I was on mute. On sell-through rate calculation, the times 100 piece, is it meant to be times 100% units sold over beginning inventory times 100 or times 100%?
We're trying to figure out, it's a percentage. We're trying to figure out how much, thank you. Catch a mistake in my PowerPoint there. We're trying to figure out our percentages, right? How much of our inventory are we selling through on a regular basis based on, and break it down based on your types of inventory that we're working with to figure out how much do we need to restock based on inventory. If you're buying in bulk from one supplier and you're buying just a huge supply of different pieces of inventory, this can make a big difference in understanding, maybe I really need to stock unit A before unit B, or I really am not selling this quite as fast, but it's still important for my business and it doesn't deteriorate in value. So tracking your sell-through rate based on different product types and categories that are relevant for your business can be a huge help for you.
Sales per square foot number, is that monthly or annual number that you showed?
Those were monthly figures there, but what we want to say again is those figures were pulled in pre-COVID. What's most relevant here, I don't want you to worry so much about those dollar figures. What I would want you to take away from this is to think about optimizing the sales per square foot for your business, for the type of business, for your branding, and for your location. So I guarantee you this, any commercial real estate broker that you chat with is going to love to talk to you about this and to love to talk to you about what's going on in different regions, in different areas you're interested in or currently operating in, because this is the analysis that they do all day. They're trying to figure out what real estate is valuable and when it's appropriate. So I highly recommend reaching out to your trusted contacts there.
I import product from India and will likely do so several times a year. How do I account for currency conversion fluctuations when calculating value of inventory and my costs?
Got it. We're going to, on the accounting side, if we're importing in inventory from overseas, if we're having transactions where we're paying them out, not in our existing currency, or we're having currency fluctuations, you're going to end up having what's a gain or loss on exchange on your inventory. So these can end up, these are going to end up on our P&L that we're going to be reconciling. So very happy to chat with you offline about that as well.
Any advice for investigating COGS pre-revenue?
COGS pre-revenue. So the first things I would say, if you're trying to figure out what your product is going to cost, talk to your suppliers, right? Figure out what our suppliers are going to be. Find out if you have an existing potential manufacturer, I'm going to take a shot here and say that they work with distributors already, meaning someone who's going to be shipping out their goods potentially to you. So you can start shopping around to figure out what it's going to cost to bring in your goods from your manufacturer, from your supplier. This is going to help us figure out our inventory costs. This is going to help us start working on building that relationship with the supplier that's so important, and make sure that we're trying to get good terms when we can in terms of the payout. Understanding that in the retail environment, we're going to pay out that cash on the front end for our inventory, and we're not going to be able to collect it until we actually get that over-the-counter sale. So make sure we understand that. Make sure we're having a conversation with our potential distributors is a great way to get started.
If you finance a big inventory purchase, does the P&I live in COGS or SG&A?
P&I, I'm thinking you're talking about your financing, your interest on these loans. That's going to end up in our interest expense when we're financing those. If you may be able to get benefits of things like early payment discounts that we can take out. We may be able to get payment type discounts or other payment plans we can take advantage of as well. But making sure that we're tracking those and understanding that against timing is going to make a huge difference for us.
Where can I find what key retail performance indicators should be for a particular type of store?
Got it. I would start with your industry association, right? Your industry associations most likely are going to make quite a few of these things public. Find out if there's a publicly traded company that's also operating in your specific niche, whatever that is on the retail side, start combing through a few sets of the financials or combing through with your business partner, with trusted financial partners in the industry associations to have those conversations. We want to understand the information's out there. Those groups are trying to make it public, I would say in the vast majority of cases, particularly when it's public businesses. So we can find that out.
Will there be a retail cash flow forecast discussion in the future?
In terms of the cash flow forecast, this is certainly something that we could help with. It's not planned through SBDC right now, but as always, if we get some requests for it, reach out to Hannah or Julie, and it's something that we could certainly set up. Cash flow planning and forecasting for a retail industry is going to focus, of course, on our big purchases, inventory coming in, your traditional rents and outflows of cash on utilities, and tracking through payroll to make sure that that's moving appropriately with sales. So there's some really great things that we can do there to plan for cash flow in a retail environment. If it's something you'd like to chat about, definitely let Hannah and Julie know, and we can figure out if we can set something up, or happy to have a one-on-one conversation.
All right, those are all the questions I have.
Tremendous. Well, thank you guys so much. This is always a lot of fun. Hope you picked up at least one or two great KPIs that are going to be helpful for you here. This is not, in general, I want you guys to think about it. I know that everything is crazy in the retail environment, but this isn't accounting for the sake of accounting. You can really drive your business with quite a bit of this information to help you at least make a little bit more profitability, cover costs a little bit better, cover your cash flow a little better. And keep our business on the upswing. So looks like I'm seeing a few. Oh, no, I just see all your messages in the comments.
Just compliments, telling you thank you.
Oh, thanks guys. Cool. Well, everyone have a wonderful day, a wonderful weekend. And if you have friends in the manufacturing or software space, tell them to join us in the next few weeks.
Great. Thanks so much, Joe. We really appreciate it. And thanks to everyone for joining today's webinar. Join us again next Thursday for part 3. We're here to help you and your business start, grow, and succeed. Thanks so much again for joining us. Stay safe and healthy. Thanks, Joe.
Take care, guys.